Hey guys, we're back with another evaluation video. Today we're going to take a look at ticker symbol V or Visa. Visa is a fairly well-known stock and it has been up around 13.72% this year. Fairly good. Has not beat the S&P 500 but has remained very close with a yield of 0.75%. Visa just recently released their earnings report for quarter 3 of 2023 here in July, on July 25th, 2023. And just a few things to highlight. Their net revenues increased about 12%, and they had share repurchases or buybacks of dividends of $3.9 billion, just making your dividends a little bit more valuable. So what do we do here when we evaluate these different securities in stocks? Well, first we run them through our discounted cash flow model, run them through Graham's model, run them through the dividend discount model, figure out the valuation for all three, average them, find out the final valuation, apply a margin of safety depending on what type of stock it is. If the stock is a very long-standing stock with a very good history, probably a little bit less margin of safety. But if it is a very erratic stock where you have a lot of erratic annual free cash flows and the dividend payout is not very consistent, then probably apply a higher margin of safety. And once we are all done, we click go, and then this will tell us if it is a buy or sell based on our inputs. So first off, for the discounted cash flow model for Visa, we have to get the previous 10 years free cash flow numbers. There's a lot of different charts online that has that information readily available for you. Y Charts is a very good website for that. They do have quarterly free cash flows, and then it appears that this is the rolling 12-month free cash flow. So what we did to be a little bit more accurate than, say, the macro trends data. Now the macro trends data gives you the annual snapshots, so 17.879. It does not include the 2 quarters of 2023. So we'll go ahead and take the 2 quarters of 2023 and add them into our rolling 12. So what we're going to do here is for the most recent free cash flow number, now we need the previous 10 years. So we'll go a rolling 10 years. So for 2022 or 2023, 8.66 billion. And then for June of 22 will be our next previous year's number, 16.06. June of 21, 12.69, and we'll copy all those over to our calculator, and this will give us an average growth rate for their free cash flow. Now the perpetual growth rate, typically I put 0.5% to 1%, just saying if this company were to grow into infinity, what would you expect the company's growth rate to be? The discount rate is simply the percentage of return that you would expect to return if you were putting your money anywhere else. You want an 8% return. This will give you a value for this security. And for the discount rate, this 8% is saying that if we were to put our money anywhere else, what type of return would we expect or would we want? So as you increase this discount rate, it will change the valuation of what you think you should buy Visa at. So typically, we're just going to leave this at around 8%. Very similar to our dividend discount model, we're expecting a return of 8% on our cash in the stock market. So for cash and debt, we can find that over on Yahoo Finances page for Visa. Come over to the financials, come down to the cash and cash equivalents, 18.5 billion, coming down to total debt of 22.45 billion. Put those into the calculator, and then that will give us a value for the discounted cash flow model for Visa. Now for Graham's model, we simply need an analyst's estimate of the next 5 to 10 years of growth that they expect for Visa and the AAA corporate bond rate. The AAA corporate bond rate, that's a quick Google. You can Google AAA corporate bond rate and see what it is today. And today it's sitting around 4.8%. Where are we going to get this growth rate or the analyst's expectation? Well, if we come back to Yahoo Finance, come over to analysis, all the way at the very bottom, the growth estimates, the next 5 years per year, 14.59%. So that finishes up for Graham's model. Over on the dividend discount model, now where are we going to get these figures at? Let's go over to Seeking Alpha, and over on the Dividends tab under Dividend Scorecard, it has what we need: an annual payout of $1.08 and a 5-year growth rate of an astounding 16.89%. Now, we can't put this number directly into the calculator. If you understand anything about the dividend discount model, this number will break the dividend discount model. So this 5-year dividend growth rate, I believe a more sustainable figure is going to be keeping it under the return of the market. So if Visa were to smooth out their dividend growth rate, if they were to slow their dividend repurchase or buyback program, slow that down, that would give us a more smoothed out value of 7%. And that $1.80 dividend payout, we got that from Seeking Alpha. This right here, the 10-year bond yield is 4% currently, and that, again, just like the AAA corporate bond rate, that is a quick Google. We're going to expect around 8% return of the market, just like we did for our discounted cash flow model. We'll go ahead and apply a 25% margin of safety and click go and see what we get. So the discounted cash flow model, free cash flow growth of 15.74% average. This trend line right here, you can see the free cash flow has grown about 15.7% over the past 10 years. So that values Visa at $495. Graham's model, with a 14.5% growth rate as the analysts expect, Graham's model gives us a value of $155. The dividend discount model, with that 7% 5-year dividend growth rate, gives us around $204.55 for the dividend discount model. So with these current figures in for Visa in the calculator, we have a buy or sell signal of sell. If we were to change our margin of safety, if we feel very comfortable with Visa's current growth rate, we could knock down our margin of safety to about the 10 to 15% range, and we get very close to our current price of Visa, which would then turn us into a buy. So let me know what you thought of this analysis, if you agree or disagree, and let me know what you want to see next. And with that, thanks for watching.